Howdy, Jacob here. Today we're looking at Taiwan Semiconductor Manufacturing, ticker symbol TSM, company 125 of our high ROIC screener. Market cap 733.7 billion. Enterprise value looks the same. 1987 was when the company was incorporated. Huge return on invested capital, historically in the 20% and recently much higher, with gross margin increased from 49 to 59%, operating margin 39 to 39%. 49. I don't know why I said that. So their gross margin of 10 years ago or 9 years ago is what their operating margin is today. That is substantial. That is immense. Little bit of increase on their dividends. Looks like they're focusing on reinvesting, which is exactly what I would be doing if my return on invested capital was 20 plus percent. Look at that balance sheet. We see 44 billion cash on hand, 7.9 billion in short-term investments, long-term debt of 27 billion, 630 million short-term debt. No concern there. They have more cash on hand. They can pay off all their total long-term and short-term liabilities. No concern there. Cash flow has huge reinvestments. We see that their capital expenditures were 9 billion in 2014 and are now 35 billion in 2022. They're heavily reinvesting back in themselves. They're buying back the babyest amount of shares. I'm going to say that's back, or say that's nothing. Inconsequential to the. They also increase stock-based compensation. So their dividend pays out 9.3 billion in aggregate, and that is actually quite a lot of their 5-year average free cash flow. That is a lot of their 5-year average free cash flow. So 17 billion is the year ago free cash flow, but on a 5-year average basis, you're probably looking at 14, 13, 12, let's say 12. So that's paying out a huge amount of free cash flow. But their earnings must be way greater than. Okay. So that's not what I like to see. I prefer companies that are opposite or at least similar. I prefer similar, honestly. Companies with very similar free cash flow to their net income is very positive, but I prefer if it were to be different, free cash flow be higher, since free cash flow incorporates appreciation, depreciation, then net change of working capital. And I just, I guess I do enjoy they're investing so much back into themselves. This is kind of similar to an Amazon where capital expenditures have grown 4 or 5 times um, in the last couple of years, but I do still prefer free cash flow to be coming out a bit higher. I think I'm ready to make some assumptions here. So we do see a decrease in the last year, but semiconductor industry, I know, is projected to grow double-digit CAGR over the next decade, I believe, or per year over the next decade. That's why I said CAGR. And then they are the company in Taiwan that's they could cause some problems. I'm not going to get into political stuff. So let's start making some assumptions on the revenue growth side. I think that probably 8% seems pretty reasonable to me. I think an 18p price to free cash flow, based on the fact that at the end of 7 years, probably still have quite a bit of growth ahead of them. And I wouldn't be surprised at all if they, had pretty as much dominance, if not more dominance, than they do right now. I'll even jump it up to 20p and 10 revenue growth, based on the fact that the semiconductor industry is gaining 10% a year CAGR over the next decade, and I just think there's no way that they don't eat that. They're going to eat that pie as well. And then I think they're going to have an even bigger moat today than they do. Less growth likely, but bigger moat. So I'm pretty comfortable with that 20 PE. 38, 21. I hate that. I hate that it's lower. Ugh. Let's do maybe 32 and 28. I'm bumping this free cash flow up, saying that they figure something out to where they're starting to make some money again. No share change on the dividend side. I don't want them to increase it. It's paying out a huge portion of their free cash flow. I want them just reinvesting like crazy. And it just looks a little expensive right now. I think these are pretty solid assumptions right now. And so To me, we're just looking at a price that's a little bit expensive. I could see how, people in this industry, with especially you tell AI and they're like growth is going to be astronomical, 10%, why not 30% or 25%? Boom, 25%. It looks like it could be a buy price right now, but to me, 25% a year for a company this big, I do not see happening. I'm basing this off of history and then their ability to reinvest back in themselves, being able to grow at this rate, I think is reasonable to me. And so that's the assumptions that I'm going to set. And I'm just saying that at this price point, it's a little bit out of my desired buy price. But hopefully you enjoy the video, do your own analysis, have fun with it. And I hope you have a great rest of your day. Thank you.